the fact that the Bank of England had to step up and prevent a potential financial crisis in the UK based on a blow-up in the pension system. But what that really did was finally get people on Wall Street to recognize that the Federal Reserve is probably in the same predicament, or will soon be, as the Bank of England, having to choose between a financial crisis and fighting inflation. Well, the Bank of England already made its choice, and it chose to fight the financial crisis. Inflation be damned. And I think the Federal Reserve, despite its tough rhetoric, is ultimately going to make the same choice. And I think based on the perception that that choice is looming, you got that big rally on Monday. And in fact, the Tuesday rally was even bigger. On Tuesday, the Dow closed up 826 points. And the catalyst there was a shockingly bad JOLTS report. What the JOLTS shows is the number of job openings on the month. That's how many jobs employers are looking to add. And the expectation was for 11.15 million, which would have been a slight reduction from the 11.239 million the prior month. Now, the prior month's number was revised a bit lower to 11.17 million, but the August number collapsed all the way down to 10.053 million. That is the biggest one-month drop in the JOLTS ever outside of the COVID lockdown. There was a month in 2020 when it was a bigger decline, but that was an abnormal time period. So this was the biggest drop during normal times, if you can describe what's going on right now as normal times. And when the markets saw this number, there was a huge rally. Why was this so exciting for the markets? Because everybody believes the key to the Fed's inflation fight is unemployment, that the Fed needs higher unemployment to reduce inflation. And the fact that the job market is weakening, that is the good news that investors are looking for. And so we saw a big move up in the stock market, a big move up in gold, a big move down in the dollar. All the computer algorithms immediately reacted to this report on the health of the U.S. labor market. But again, this is a fallacy that inflation can be tamed by creating unemployment. It can't, because inflation is not created by employment. So if people working doesn't cause inflation, putting people out of work won't solve inflation. In fact, if anything, and I've explained this on the podcast, people productively employed helps counter the effects of inflation because it increases the supply of goods and services. Because those workers are making something, they're helping to produce a good, they're providing a service. If those workers are no longer on the job, presumably fewer goods are being made, not as many services are being offered. And so if you want to buy some of those goods or those services, you're going to pay more money because the supply has gone down. If the demand is the same, or if the demand is going up because of money printing, then you get an even bigger increase in prices. So this is fantasy that higher unemployment is going to reduce inflation, but that's what everybody believes, and that's what the Fed believes. And so that's all the markets care about, is how the Fed is going to react. And so if the Fed is convinced that a rise in unemployment is what they need to reduce inflation, to the extent that they see weakness in the jobs market, and that portends an increase in unemployment, well, then maybe the Fed will feel that its work is done and it can back off on the rate hikes. Cold water was thrown all over that theory over the last couple of days, where the Dow Jones dropped better than 1,000 points since its two-day rally that started the week. And the big catalyst for the decline today was not only the worse than expected non-farm payroll number, and by worse than expected, I mean better than expected in that the unemployment rate went down, but that good news is bad news when you're hoping for an increase in the unemployment rate. But also what the markets did not get on Friday or Thursday was confirmation from any of the FOMC members that they are moving closer to a pivot like their colleagues at the Bank of England. In fact, if anything, the FOMC members continued to talk tough about fighting inflation, how inflation is still too high, they still have a lot of progress to make, They still have to keep on raising interest rates. They are laser focused on fighting inflation, and they're not deterred by the prospect of a financial crisis here the way they almost had one in the UK. And so since the markets didn't get confirmation to that suspicion that maybe we were getting closer to the peak in rates and closer to the first cut, that was negative for the markets. But I think the biggest problem on Friday was the September jobs report. So let me get into the details of that report. The consensus was for about 250,000 jobs to be added during the month, and we didn't beat it by that much. The increase was 263,000. The number that I think really spooked the markets was the unexpected drop in the unemployment rate, which went from 3.7% all the way down to 3.5%. So it's headed in the wrong direction if you're hoping for higher unemployment to put an end to the rate hikes. This means that the Fed is even further away from its goal if its goal is to vanquish inflation by creating more unemployment. So as soon as this number came out, the markets tanked. Not only did the stock market go down, gold went down, the dollar went up, because again, this means the Fed is going to raise rates more and they're going to have to stay higher for longer in order to drive unemployment up, to drive inflation down. And one of the reasons that the unemployment rate went down was because more people left the labor force and are therefore no longer counted as unemployed. Labor force participation went down from 62.4 to 62.3. And so that means some of the people who were looking for work threw in the towel. They decided they no longer want work. They're not part of the labor force. And so that brings the unemployment rate down. But having fewer people in the labor force puts additional upward pressure on wages, because after all, there's a reduced supply of workers. And so if you're a company and now you want to hire somebody and there's not as many people in the job market, then you may have to pay higher wages. And so that's also a negative for the markets that are worried about wage price inflation. But again, that's incorrect. Rising wages don't cause prices to go up. Rising wages are prices. Wages are the price of labor. And so the price of labor goes up for the same reason that the price of goods goes up, and that's because of inflation. The inflation doesn't come from the private sector. It doesn't come from workers. There is no spiral. There's just the government. The government sets the whole thing in motion. The government inflates the money supply, and the result is that prices go up, whether they're the price of goods or the price of labor. Everything goes up as a result of the inflation that the U.S. government creates. And so far, the government has virtually made no headway in its battle against inflation. The Fed is no closer to returning inflation to 2% than it was when it still had the Fed funds rate at 0. Even if we get a slight reduction in the headline inflation rate from the 8.5% or whatever the last print was to something somewhat lower than that, that still is not going to bring the Fed any closer to its goal. Because despite all of these rate increases, interest rates remain negative. Even the yields on the 6-month, 1-year, 2-year U.S. Treasuries, which are all north of 4%, are still negative when you're looking at 8% inflation. And you are not going to fight inflation with negative real interest rates. Remember, the most important thing about fighting inflation with rate hikes is changing people's behaviors, changing their savings and their spending habits. But the Fed has not done anything to alter those habits. Americans are spending as fast as ever. They're borrowing as fast as ever.